Greetings, everybody. This is Jeff Scott. It is, well, it's still the 11th, but by the time I post this, it will be the 12th of January 2020. And this is my weekend review. The sound quality may not be up to snuff because I'm doing this remotely. I am currently in Tampa, making my way out to San Francisco for the JP Morgan Healthcare Conference. And I actually stopped to go to a Vantage Point 3-day power seminar. So may have some interesting things to talk about that program. And does artificial intelligence play a role in our stock picking? So far, I have to admit, I am impressed. I'm enjoying some great hospitality, and maybe this program I've had for 10 years, I should actually be using more. As always, this is for education purposes only. Any recommendation of the Spirit of Education, not investment advice. I'm a doctor, not a broker. I am independent. I say what I want. No one pays me to say good things or bad things. And I pay for all the tools that I use. And trading involves risk. You are solely responsible for any decisions you make. I always title my education, Be Your Own Guru. If you're new to this program, I really like to call out the folks that influenced me. I started with Can Slim from O'Neill. Here's his famous book, How to Make Money in Stocks. And then I improved it. Morales and Katcher were money managers who worked for O'Neill. They developed pocket pivots, Bible gap ups, and other things. This here is Ian Woodward, really my mentor. I owe so much to him. And a lot of the reasons I do these webinars is in respect to his memory. He took CanSlim and made it something that I could actually do myself. And he worked with George Roberts, created a great software tool, Hgsi. Ron Brown, like me, was in the audience and became Ian's partner. Ron uses Hgsi and has gone down the path of volume spread analysis and really has done amazing things with the tool, a different style of trading than mine. We find similar stocks and we both know how to make money with it. Down the lower left, my buddy George Lee, who I get to share the podium with from time to time. Van Tharp, the king of position size and money management. Sagar from Superior Profits, some great tools. And then how do I put all this information together and figure out how to make a trade? And that's where John Person came in, whether it's his indicators, his live meetings, or his books. He's been a huge influence on helping me figure out not how to build a list of great stocks, but how to actually make money trading them. When I do my education programs, I call it Be Your Own Guru. You don't have to do what I do. You have to learn yourself. Now, to become a physician, most know that I am a cancer doctor. We all do, well, most of us, if not all of us, did 4 years of high school. Some probably got through in 3. Then if you're going to be a profession, you're going to do 4 years of college, most likely. Then I did 4 years of medical school. That's 12. An internship, 2 years of residency, that's 15. And then 3 years of oncology. I did 18 years of education and invested probably $400,000 from the ages of 18 to completing my fellowship. And paying back loans, etc. You're not going to wake up one day, read a book, and become a great trader. I've been doing this for 20 plus years. I've been to countless educational seminars. I've tried too numerous to count software programs, and I'm still looking to learn. The Be Your Own Guru means learn from smart people. Figure out what works for you. What I do doesn't have to work for you. It's no skin off my back. But find something that makes sense and make it yours. And to me, that meant finding smart people, learning from them, and coming up with a style of trading that is unique for me. I own almost every tool on the market. As I said, I'm at a Vantage Point, which turns out to have a huge user base. I'm at their program, but I need TradeStation, Thinkorswim, and I use HGSI, EdgeRater, and the Superior Profit tools on a regular basis for helping to manage my trading. Here's the website for HGSI. There's a no cost to download, free 30-day. They don't even ask for a credit card, which is silly. And under investing strategies, you'll see hundreds of movies by me, Ron Brown, and others. Stock patterns are cyclical. I always ask my question every day at every stock, every industry group, where are we? What does it feel like we're rolling over? Now, I'm a broken record. I've said that a lot in the last few months. And I'm the first to admit that every time it seems like we're rolling over, we pop with another leg up. So we can all hope, but I'm a little concerned that we at least have a pause for refresh. Therefore, I ended the week selling off a lot of my bull put positions because those go against you if the market goes down, and I'll probably take additional profits. I also roll my options up and out, which meant if I had $190, or in this case it was $160, $260 Apple calls, I then sold them back, pocketed $50 per contract, and bought at the money or near at the money calls and sold some out of the money calls to reduce my cost. So I moved my strike price up and I moved the month out. And that's a way of taking profits along the way if you own options, because the worst thing is to be holding a $50 in the money option and have the stock go against you, and that's $50 times 100. You don't want that to happen. And it's happened before. So what does that mean? It means I started to raise cash, reduced some of my positions, and sold some calls or premium on the positions. I am nimble. That's the advantage that we all have as individual traders and not institutions. And I'm ready to go more aggressive if the market pops again, but I'm also ready to start to get defensive. And I think what I did would be considered defensive already. This was a crazy week and a crazy start to the year. And as you can see, lots of red again on a Friday, and healthcare had some green, but it was a really, a bad finish on the markets, although I didn't do as bad as I thought I did because in the last half hour captured back about 20,000 of my losses. Sounds like a lot, but it's really insignificant on the account that I trade. If we look at the major markets, I think there's a reason to go deeper than just a PowerPoint slide. And by the way, I use PowerPoint so I can get more done in a shorter period of time, but they're actually real pictures, just like if I went to the program. Here's 1 year worth of the E-minis. And what I wanted to point out was a couple of things. Actually, I made this the weekly for a more important reason. The E-minis closed or hit a high of the year, all-time highs this week. There's a bit of a spinning top here, prior doji here. And when I start to see these types of bars, that's showing me indecision in the market. So that is one of my concerns, but I have other concerns which we will review. I am also looking back historically and seeing that the market topped the week ending January 22nd of 2019, and we did not retake the prior highs until the week ending June 27th. It feels, August 27th. Did I say June 27th? You get this date correct. I mean, not on the weeklies, it's actually September. So it took us 6 months or longer to recapture the lost ground that we did in 2000 and all right, I was correct on my dates, just the wrong time. 2018, I'm sorry because I was looking at the daily before. Again, the story is we peaked January 22nd. It took to September to recapture the highs. 2019, we peaked. So it looks like, let me go back to the daily because that's where I did my analysis on. 1 second. Apologize for the little bit of confusion. I shouldn't have had the wine at dinner. Right back on a daily. Let's bring this back up. Yes, it doesn't show up. So it's 2018, the sell-off. We sold off in 2019. We didn't sell off until later in the year. The point that I wanted to make was that will this be another peak in early January and a sell-off? So back here in 2019, we peaked the week ending January 18th, and we had a reversal, but we caught back up very quickly by the end of January. But we have a history in 2018, a significant drawdown that took until September to recover, and then in 2019, we had a modest pullback. So we're into that point of year. Does that mean we're about to pull back? Now, on the daily E-mini futures, you could see a red candle high. What does that mean? It means it's the highest bar forever to the left. So I don't have to worry whether it's 10 or 20 bars. We opened, we traded up, and we closed down on the day, so it's a red candle. A red candle high is a one-day reversal candle. That's bothersome. If I look at the NASDAQ futures, we hit an all-time high daily on Friday and gave us a red candle top. If I look at the Dow futures, I don't want to sound like a broken record, but we set an all-time high on Friday and closed down on the day a red candle high. I've got evidence of topping in each of those indexes. If I look at the Russell, it's not yet retaken its past highs. It's clearly come down from its recent high of the past year. The VIX still doing nothing, so it's not really confirming weakness in the market. But a doji can be an indecision day, and it wouldn't shock me to see reversal to the upside on Monday. And the dollar rallied back up into the 50 and then came back down. So the dollar is certainly not its strength right now, and the dollar's been whipsawed a little bit about with Iran, etc. I know a lot of smart people think that the dollar's actually going to go down, which wouldn't necessarily be bad for my stocks. So 2018 we sell off in January 2nd, 3rd, or 4th week. 2019 we sell off in January 2nd, 3rd, or 4th week. I think history is going to repeat itself. On the weekly charts, you can again see we've had weekly new highs. Not much else to tell you on this. Now, what's underneath rates? I don't know if I could say stabilize. Yeah, it was kind of a nothing week on rates. They moved up a tad. They really didn't change much at all. If I look here, it's hard to see the light blue, but you can see the yield curve looped down a little bit as far as the 210 difference. But it's well above the line of inversion, so not a signal. Now, if you want to be bullish, you can be bullish because on the right, large caps in white, the AD line, and the IWB in red show that the large caps are at a new high and new high, all-time high on AD line. Small caps here also at a near an all-time high on AD line. And notice how the IWM is rapidly capturing up, where a few weeks ago it was a big laggard compared to large stocks. That's a pretty bullish signal. If I look at the NYSE, it's right off of its all-time high, and you can notice that with the rates ticking up just a few pennies, the bonds here in light blue gave up a little bit this week. Now, one good thing about one day of weakness is that it eased our overbought state. We came back just a tad on the 200-day stocks above the 200-day. Now, that's a thing that takes forever to change. But we came down on the 40, and more importantly, on the 3-month new high, new low, where 2 weeks ago we were at imminent reversal. We've eased off, so there's no signal here. The daily McClellan still is the bad boy in that we have significant and worsening divergences between the oscillator and the summation index and price, and the weekly as well. Look, you don't think that's called a melt up? And look, we don't even get close to taking out the prior high on the weekly oscillator or summation index. My buckets, let's take all the stocks in the S&P 1500 and first ask the question, how many are above versus below their Bollinger Band midline? We are neutral. If you look at the stocks where they're falling within their Bollinger Bands, this is massive weakening from the last 2 weeks and shows a market that's much more balanced with risk to the upside and downside and no signal here of overbought, oversold. The left is NASDAQ, the right is the NYSE, and you can see down there that there's no evidence of a Hindenburg omen, and we still have very few new lows, and without new lows, you don't get that signal. The Hindenburg omen would be a sign of potential market weakness in that although only 1 out of 4 Hindi signals cause a significant downturn, there's not been one in over 50 years, a significant downturn without a Hindenburg omen firing. Market tone, this is the Woody indicator, percent bandwidth times percent B times bandwidth, and we had 2 of our indexes turn red, so some weakness in the market, suggesting at least a pause, if not worse. as well as sector strength weakening where we have a number of red sectors. So clearly this market has changed its character from a week ago. The canaries in the coal mine, which is sort of my FANG extended, you can see them here, and obviously something I've got to fix. This price line is now called booking. The canaries have set a new high with a spinning top and a red candle high on Friday. And again, is a reversal imminent. Now, you notice this little greenish line here. That's my high jump bar. When I see the high jump bar maxed out, meaning the most extended we've been over the past year, and the red candle high, that to me is a concerning signal that we are in an area that suggests we're at risk of a reversal. Know your news and earnings. There is some employment numbers, weekly jobless rather, on Thursday, and boy, is this a week of Fed speakers. Now, it's time to start thinking about earnings. It's a modest week. The banks come on Tuesday with J.P. Morgan, followed and Wells Fargo with Goldman Sachs, Bank of America to follow on Wednesday. Delta Airlines is the first big airline to report, may give us a sense of the health. Now, I will tell you that Delta, whether they're lucky or good, I'll say they're good because one of my neighbors is the CEO. They don't have a 737 MAX issue, so they may turn out to continue to be better than some of the other airlines, which have some issues related to that. You got Schlumberger on Friday, a big energy. You got CSX. So it's a mixed week, but not a very busy week of earnings. As I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's a bad judgment to not know when your stock's earnings date is scheduled. So let me pause for a second and clean up this. Okay, so market thoughts. One-day reversals numerous as markets sell off late Friday. I find that concerning. Take a look at the last 2 years. I showed you 2018 and 2019 peaks in mid to late January, and at least in 2018, it took significant time to retake the highs. Will we see a repeat this month? I'll bet yes. Many reasons why I do not expect a major, long-lasting pullback. Fed is on the sidelines. Economy is strong. And look at the resilience in the face of escalating tension with Iran, including missile attacks against us in Iraq, impending impeachment. No one seems to care. You got the election with a shift to the left of the Democratic Party, obviously not showing up in the major averages, and the AD lines at a new high. It does feel like the market's gotten ahead of itself, and I would not be surprised to see at least a pause. I am still near maximum long in positions, but took profits on Friday, especially on some of my recent purchases that explode to the upside. I want to look at two of the stocks, show you how I played them, and how I adjusted my position in the setting of volatility. Now, in the last week or two, I talked about CrowdStrike. CrowdStrike is involved in the internet security, and one of the things that is related to the Iran attack is a concern for increased cyber terrorism. So anything in cybersecurity. So I purchased it where this line is. Everybody's followed me. I've got a pullback to the 50, a little deeper than I would like. It's an IPO, two kahunas in a row in a squeeze. And I didn't just buy stock. I bought it right off the 50-day moving average. I did my favorite option strategy, one that we review here often, of where I buy a call and sell a put at the same price point, creating a synthetic stock with a P&L identical to if I bought the stock. And then I buy a protective put so that if I'm wrong and the stock goes against me, I'm capping my loss. Now, if one puts together a P&L curve of this position, it will look exactly like a synthetic call option, a lower cost of entry, but a little bit higher risk. One could see how fast these things become profitable because I'm making money if I'm correct on these two, the more expensive legs. The protective put, it's insurance, and it becomes less valuable. So what did I do on Thursday? I took this at 10 o'clock in the morning on Thursday, and I immediately sold the put spread. I sold it Friday morning, where I took profits. So I still was up over $2,000 in a couple of days on the put spread. and I stayed with my long position. And you could see prior to me closing out part of the trade, this is a Thursday, and the stock continued to go higher. I was up $14,000 in about 3 days on a trade that had very little out of pocket. I know one of the negative feedbacks I get is I trade from such a big account. How does that impact? How do others do it? This was not an expensive trade to take. It was a way to control, and I can tell you exactly what I paid on the long call. Since I've sold the other ones, I don't think I have. It'll be a little bit of work to go back and find that numbers. But the long calls, let me get that right now. I paid. Actually, I've got the whole thing. I paid $5 for the long calls. They're now at $8. On the long put, a short put rather, I paid $3.36. So that meant I paid $1.65, say, to control 4,000 shares. So I paid $6,400 to control 4,000 shares and give me the same P&L as the stock. And then I paid, that's a losing trade on the third one. On the protective put, I paid $1.57. So I think that means I paid about $3, $3.20. So 4,000 times 320 is I paid $13,000. So here I am 4 days later, up over 100% on that trade, and I take off the two puts, reduces my risk to the downside, and I raise my stop on CRW, RWD, and I won't take a loss on this trade to break even, and we'll let it run for a while. Now, this is not a typical high growth stock breakout play. It's kind of a cup and handle that occurred in a deep base, so it doesn't count either. But this is what's been working in the market. Case in point, last week we talked about AYX on this call. And here was why we talked about it. On Thursday, I had a kahuna and what we now know as John Person buy signal occurring as the stock was approaching the 200-day moving average. I set a buy stop above the high of the day here. So I bought in on Tuesday, I believe. I bought in on Monday. And I remember on the weekend, it was like $4.85 a contract. And I didn't want to forget, so I just put a buy order in at $3. And the stock traded down some when it opened on Monday, and I got filled at a low price. So AYX, just for comparison's sake, and I think, I don't have the full price on that because I've sold a bunch of the legs. Paid about $3.20 for this contract. I only bought 20 contracts, so that's 2,000 shares. Every one contract is 100 shares, so 20 is 2,000 shares. I paid a little bit over $3, so let's say at the most I paid $7,000 for that spread, and I'll have a profit today of $18,000 3 days later. So that's a 2.5 to 1, 250% return in 3 days. And I did cover the short put position, and it's covering. Again, to protect my risk, and I bought it back. As you see here, it would have been about 15 cents to buy it back. Those are trades I love to take, but the way I manage these trades is I don't just set them and forget them. I take the trade and I try and close out the bull put spread, so the short put at the money and the protective long put, because that's where my risk is. Yeah, this could go to zero, and that sucks. But I'm going to get, what I'm more concerned is that this one goes against me as well, because this one has potential of 10, this is only 5 points here, but that's $10,000 of risk that's sitting there if it maximum dropped down to the 100 level. So those were two plays, very typical. I get mixed feedback. Some people like it when I share what I do and show my account. This has been a bizarre beginning of the year. And again, I trade real money. I trade a portion of my retirement, and I'm aggressive. and I get to spend whatever I make in this account, and that's where I buy my cars and my boats from. But just to give you an idea, I ran my account, which at the start of the year at $1 million to over $2 million. Now, there's about 300,000 that will disappear this week to pay for taxes. But what I just want to point out is something in the lower right-hand corner. So, and this is really the source of truth in Thinkorswim. And this is the thing here that's called overall P&L year to date. So I'm up over 10%, significantly. Since you take 214 away, that means I was at 1.8, 1.7 when I started. 12 to 14% in 1 week. Another reason why I think this market's bound to correct, that's not a normal week. All right, let's look at the market in other ways. Let's give you a sense of how overbought we are. I'm going to go into TradeStation. I'm going to go into my market divergence, and I'm going to look at the indexes. E-minis. Now, for newbies, I look at 6 things. I look at daily, weekly, and monthly. Am I at a buy with a green arrow or sell? I'm going to buy in all of them. That's a good thing. I look at the color of the paint bar, and I know that green is bullish. I can be long or holding. Red is bearish. I should be short or holding. And blue is sort of neutral. I could be long, short, or holding. It's a weakening. So I've got weakening on the daily and the weekly. The third thing are these red dots, which show me MACD divergence, which suggests that a correction is coming. You can see I've got a bunch of them on the weekly. Fourth thing I look at, where am I in my auto envelope? I'm extended. I'm in the upper bands. Well, they can run the upper bands or the lower bands for quite some time, but eventually they're going to come back. The fifth thing, I look down here at my bongo and I see that all time frames, daily, weekly, and bongo. Bongo is a proprietary indicator that I developed with a couple of other friends. It's a great long-term trending indicator. It's free in Hgsi. And then more importantly, my high jump bar is at 90%. So 90% is high, but it was higher before this little pullback occurred. It was up to 98%, and then the market pulls back. So we're a little bit less overbought than we were. If I look at the Dow futures, everything's the same. Let's just look quickly where we are here. We're down to, it looks like, is that 88? Yep. If I look at the NASDAQ futures, again, everything else is basically the same in all of them. I am at 96. So we are clearly extended, or 95 on the NASDAQ futures. That would be one that I'd be expecting to see resolved. And then on the Russell 2000, we've already come down some, so I wouldn't expect it, and we're at 75%. Anything over 90 tells me that that market is extended. Over 95 tells me it's very extended. Ignoring the math, what it means is the market, in this case, it's an index, is more extended from its moving averages of 17, 50, and 200 than any time in the past year. And if I'm the most extended that I've been in a year, there's probably a good idea or chance that I'm going to probably correct and revert to the mean. In Hgsi, which is this bar up here, I'm going to go down and bring up my market analysis groups, and I'm going to go into my top-down view. And I'm doing something wrong here because I didn't open up the right group. Sorry about that. It's supposed to be 25, and I bet I'm going to get them now. There we go. I make sure I'm ranking by raw combo, and this is just a price and volume ranker. What do I see? The market was led into the weekend by utilities, gold, interesting, growth stocks, and the NASDAQ. And the laggards were small stocks, treasury bonds, U.S. oil, Russell 2000 volatility. And then look at the disparity between gold and gold miners, where gold miners are actually underperforming. If I open up some charts, and let's look at the S&P 500, I'm not going to take the time tonight to go deeply into my indicator set. For those that are new to my videos, I will send out, if you email me, I will send you out basically a Cliff Notes to what I do. It's a video and a PowerPoint presentation. For those that I haven't sent out from last week, I've been busy and probably won't get it even to the new ones to the middle of the week or late in the week. This JP Morgan healthcare conference was where they announced Southern was being purchased by Bristol Myers. It led for a lot of M&A discussion and a very exciting meeting. The prior year was all about drug pricing and everything sold off when I was there. So always something happens when I go to JP Morgan. So that high jump bar that I showed you in TradeStation is different, but it's the same calculation, just presented differently in HGSI. When I see that red candle high occurring at the high jump, I expect the market to reverse. So I am leaning that whether we pause to refresh or reverse, the S&P looks like it's tired. Now, talk to me at 9:31 on Monday, and I'll tell you what I really think, because, subject to all kinds of, news and everything else. I see the exact same pattern here on the Dow Jones Industrial. I see the exact same pattern here on the NASDAQ. And the only thing that isn't the same pattern is the Russell, because Russell's already rolled over. I look at this. Here's the high jump bar and the red candle high and the Russells. A sell signal came in and the market sold over. I think there's high risk of a market sell-off here or a pause to refresh and sideways move. But I will wait for the market to sell off before I start shorting everything and buying protection, because whenever I do it too soon, it expires worthless, and the next week the market sells off. The dollar, as we looked at before, has had a little bit of recovery and sold off on Friday. Volatility has failed. I showed you the futures. This is the VIX itself, sort of a spinning top at the bottom, a green bar, so closed higher on the day, but still in the lower part of its pattern. With the dollar having pulled back some, you would have expected some gold strength, but the gold has started to give up some of that, although gold looks a little bit different than gold miners, which really looks substantially weaker. And then we have silver as the other glittering metal, like gold, has pulled back some. So I look at the indexes, and perhaps the biggest surprise, not really when you consider the FANG, our high growth stocks, is the IBD ETF, which is a actively managed stocks in the IBD 50, actually is approaching all-time highs, but it had a red candle high as well. When I see red candle highs everywhere, I think that the market is going to pause. It doesn't mean it has to sell off. It might sell off. It might be substantial. But to me, at least, it's a pause. I'm a top-down investor. The next thing I do is I pull up my industry groups, and now I have a list here of 175 industry groups. If I want to rank them by what's moving now, I look at two-day force up. I've got 39 groups. So this is a number that was 70 or 80 a couple of weeks ago. So showing some of the weakness across the market, this number has dropped. I contrast that with the two-day down, and it's only 21. So we're still in favor of upside, but it's definitely weakening. And if I look at some of the groups here, I see some of my favorite groups. I see banks, electronics, shippers, aircraft, casinos, automobiles, semiconductors, insurance, mass merchants, diversified banks, generic pharma. Heck, the ones that are the weakest are the ones that were leading the market a couple of weeks ago. So there's been some rotation. On a longer perspective, looking at 5-day force, we have 42 groups to the upside, and I'd expect this to be close on the downside. We have 42 exactly the same. And why do I think it will be close? Because of that bucket analysis that basically showed no signal at all, overbought, oversold. We're neutral. So I like to look at what's working now, and I'm predominantly a long investor. So let's look at the two-day force up, and let's just look at the top groups. Precious metal and mining. I only look at the stocks above the index, except in special circumstances. Newmont Mining's in a sell signal. That's a John Person sell signal, that little arrow. It's pulled back to the 17. It had a sort of a reversal there. Let me switch to my chart view. A little reversal here at the 17. I'm not buying it unless there's a change that I can see, so I wouldn't put buy orders in before the market opened. Now, Nova Gold looked a little bit more interesting to me, a pretty forceful day on Friday. I'd still probably wait for it to take out its prior recent highs. None of the others are above the index, but if I skip past the index and I look at Kirkland Gold, this is another one I like. They did a recent acquisition or offer to buy and they sold off. This looks like it's getting set up to run again. It actually has had great fundamentals and great earnings. And one that I have a position in that I got to figure out what to do this week, which looks like the first two is AU. And I have my gold position sort of as a hedge. A lot of times I'll play between Nugget and Dust, long and short ETFs. And if I look at Nugget, it kind of looks exactly like the Kirkland, or not Kirkland, the AU, the Newmont, and the American Barracks. So precious metals had a good day Friday, and I don't love them. I didn't love the nickel devices either. Now, why are these groups coming to the top? Well, two things impact on Force Index. Volume, these are stocks that have good volume. The volume on Friday of the stock was 1.4 million. Its average volume is 856, and price movement moved nearly 3%. So this is a medical device company, clearly in a downtrend. I usually like to buy stocks in an uptrend. I don't like stocks that are this far below the 200-day moving average. This might be the best stock in the world. I have a hard time buying it. This one I found interesting. People who've been on my webinars before know this is a very common pattern, and it comes back to earth. It goes sideways, and then if lucky, for those that hold it, it goes up again. Well, this is the first sign of a stock that might be going higher. So it's one I'm at least going to put on my watch list. I wouldn't take a big position, but I might take an exploratory position. Here is Exonics modulation techniques, a viable gap up with a mobile breakout. Here a squeeze and a kahuna. That's a very bullish move. Doesn't make any money. Never heard of them. Very little sales. I'm not interested. Medtronic is a fairly nice pattern. Lower left, upper right. I would have rather bought it a week ago because it's broken out here and I think it's too far gone, and I don't chase when I think the market's slowing down. Novacure, I actually have a position in. I bought it back in the 30s. It's a very interesting company that treats tumors with microwaves, has some very excellent data, and now has Medicare coverage. It regained its 50. It's a longer-term position, or else I should have sold it. I'm mixed on it. Earnings will likely improve because of the reimbursement. Right now, the fundamentals are not great either. I don't see an obvious buy point. And this one is probably the most interesting of the bunch. iRhythm, IRTC. No earnings per se. It does have some revenue. Why do I like it? Because think back to that CrowdStrike and AYX. I broke above resistance of the 200-day moving average with a big move. What's missing? Well, it's a downtrend. The others may not. We're also in a downtrend, but there's no kahuna, there's no pocket pivots, there's no mobile breakout from a squeeze on Friday. So I didn't put this on my buy list either. I figured I could find better stocks. This one I probably missed. Was an interesting play on Thursday, a viable gap up from a squeeze with a mobile breakout. But again, it's a sloppy sideways pattern. It just as easily is going to come down as go up. That's enough. Next one now is internet-based services. Here's a stock I do like. Does this not look like the AYX and the CrowdSpeak? This was a growth stock that sold off hard, went sideways. A couple kahunas in a row always get me excited. A mobile breakout from a squeeze. Person indicator, it took out the chandelier stop. This was a buy on Wednesday. I don't think it's gone too far. And Zscaler, as you'll see, made my buy list. And a weekly high close doji is a very bullish, an appropriate one, meaning in a downtrend, signal from John Person. Uber, I talked about a few weeks ago. That was probably going up, not something I wanted to invest in. Maybe I was wrong. There's been a huge winner for me. I mean, huge winner for me. I don't own the stock. I started buying it on right here. Why? This is one of my favorite pictures, so I'm going to actually load this up and hopefully not crash my computer. I have a number of tools that I use. Some of them are standard stuff, and some of it's just plain old weird. And every day I look for special scenarios, and sometimes those scenarios are related to stocks that are like a rubber band man, that are either so extended to the upside or downside, they're going to make a move, and I want to take advantage. So Shopify, it's like the poster child for this analysis. On this date right here is a stock I wanted to own, pulled back to its 200-day moving average, and more importantly, it broke below the low jump bar. This is set at minus 95%. So even though it had run up a lot, this was the 95th percentile of most extension to the downside. And then it had the opposite of a red candle high. It had a green candle low, and I bought it the following day in early November in the 285, 290 range. And this stock is now up to 429, and I bought 4,000 shares or 40 contracts. Actually, I did that same type of a spread, but I ended up with 40 calls. What a great move this has been. It's certainly, well, I like my roles. I would say that I should put the license plates of shop, except it might have other connotations that I wouldn't want it to have. But this week I pushed up my strike price to closer to the money. I pushed out my months and I took profits off, because if we have a correction, it's going to come down. Too far gone, I wouldn't think I would be buying it here. Here's that AYX. You could probably still buy it here. It's a little far gone. What's interesting is the earnings per share growth coming in is very strong. So that could propel the stock higher. It is probably why it moved. Nutanix, this is a better looking group. It's a stock that's already in an uptrend. It broke above its stop. It's coming out of a squeeze, had a kahuna. What didn't make my list, but I have nothing wrong with Nutanix. Lyft, not as good looking this week as Uber. And another, all right, this is, I know people made money on this because I got phone calls. I talked about Matchcom here, why it had two kahunas in a short period of time, a bunch of pocket pivots, and a relatively aggressive move out of a squeeze, breaking above the 50-day moving average. I wish I had a lot of this. I don't, but some of my friends do, including some of my young employees, and they're talking about it, and it's run from 78 to almost to 86, 87 in a very short period of time. If you bought options, you could control a lot for a little, and that would be a very meaningful move. It too has a weekly high close doji, but it doesn't count. It's already in an uptrend. So I go through hundreds of stocks over the weekend. VeriSign, I took this trade here. I'm still in this trade. I don't know if I sold. So I had sold the other position. So I sold the puts. I'm left with a January 20th call, which I'll close out this week. And this little trade is up $16,000 in how many days? 6 trading days. And you notice these are all technology stocks and something to do with the internet and security. These are the ones that control a lot of the URLs. They went up right with the Iranian issue. This has just been a nice week for stocks that have broken above resistance with some momentum. And as I said, I've owned a couple of them. Now, one I screwed up on, because we all screw up, is this one. I don't own it anymore. I did ride it down a couple times, and I basically bailed. I looked at it at 150 and said it's going down again. And it's had a huge pop, a 20-point move that I didn't participate in. And again, if you're an options trader, that would have been a lot of money. Agriculture chemicals, he's been showing up the last couple of weeks. Nothing was greater than its index, and this doesn't look that exciting. Fifth was semiconductor devices. In this group, a number of things look interesting. This is what I call lower left, upper right, clearly a leader. So unusual to see a stock that was a great leader back here in 16 and 17, that then sold off in 18, late 18, as bad as anything in the market. And now what is it? It's a leader again. NVIDIA, I can't buy it here. It's extended. It had a red candle high. That's not a good feeling for me for this stock. Qualcomm, not so exciting. I'm looking to see if there's anything I want to buy here. These stocks have had great runs to date. This is one that interested me. It's like the other stocks. It broke above its moving averages. It had a kahuna, pocket pivot, person indicator turned positive here, mobile breakout from a squeeze. It hasn't run too far. The challenge with CRE is you're going to have resistance up here around 54 from its 200-day moving average, and the stock closed at 49, so you got a 10% move, but I would expect resistance when it got to that level. So as part of, and then the other one, Lattice Semiconductor, I think might be interesting. This one tried to break out on Wednesday and it failed. It's not over yet. Multiple kahunas, a mobile breakout from a squeeze. That's one that I might put on a watch list. It's a relatively affordable stock, and you can see on the weekly how it's just going sideways. It's late. I've had a long day. I'm not going to go into more groups, but I am going to go into, I shouldn't have done that. Talk about my buy watch list and maybe call out a couple of stocks that I like. So from my bottoms up and top down review, these are the stocks that I'm interested in from a long perspective. There are a zillion REITs. There are a zillion REITs for a reason. Let me open these back up. We'll talk about a couple of them. The REITs that support the cloud-based servers. There are servers even for the cloud because we haven't involved servers that are invisible and avoid gravity. They have to have a place to stay. That place that they stay at has to have security, as well as it has to have uninterrupted power supply, great access to the internet. And the big cloud-based companies don't want to own those buildings, so they basically work with REITs that own them. One is called Cyrus One, was something we owned back here. Is this not a pattern I like? It broke above the 50, had a pocket pivot, buy signal on the weekly, buy signal on the daily. I think this one looks very interesting. In that same genre is a company called Digital Reality, I believe. There it is. Same pattern. I find this to be a pattern that's been a high reward to risk pattern. I like Cone a little bit better. What else? So a lot of REITs looked interesting. I invite you to look at them. If you want to play pot stocks, it's tough for me to want to play pot stocks. This one raised some money, which means so their secondaries out of the way. They are a REIT that owns some of the pot growing areas. I am not a pot bull, nor a pot user, shocker alert. But this is a stock that has moved in the past. It pays a 3.5% dividend. It's moving and it's under a lot of accumulation. In a couple of things I don't know what Encompass Healthcare does. I'll probably listen to their presentation at JP Morgan, but this is an uptrend pullback to the 50. A kahuna, person indicator, mobile breakout from a squeeze. That's got all the ingredients I like. I probably set my buy stop above the chandelier. Zscaler, I think I showed you, but if not, Zscaler. Again, it's run a couple of days, but this is the kind of stock that's been working for me lately. Have a very loose, tight leash. If it goes against you, take it out. Another one that I liked is Twilio. I liked it better a week ago. It's already starting to move, and you got to be careful about resistance at the 200. It's very unusual on my buy watch list to have a ETF, but uptrend, sideways move, and a breakout above the 50, mobile breakout from a squeeze. My indicator, or John's indicator rather, fired, pocket pivot and a kahuna, all occurring on Friday. That is a signal I like. It does pay a 3.1% dividend. On the energy side, I like some refiners, although on Vantage Point they didn't look very good. But again, here's an uptrend, sideways move, and a breakout, mobile breakout from a squeeze. Person indicator, pocket pivots, and kahunas, multiple kahunas in a row. That's another signal I like. 3.6% dividend. That's one I'll probably take. This is PBF. Anything else that was so incredible I wanted to show you? In the biotech space, something's going on here. Nectar, they have a number of products in early stage development. They have something that I think is potentially approvable this year. That you have a nice steady move after a sell-off, and then boom on Friday, a Bible gap up, mobile breakout from a squeeze, person indicator fired on Wednesday, and two kahunas in the last 3 days. That's something that I think is very interesting. Also a high close doji. And then I made a comment about agricultural chemicals. Scott's Miracle Grow basing here sort of a shallow fire pan bottom and breaking out here with a person indicator and a mobile breakout from a squeeze. So I would be careful. I am not planning on going into the market very long or longer on Monday. I'm going to let this pan out. If you had to ask me to bet, I think we have to be careful not to err on the side of missing out on what could be a big rally based upon other things I'm aware of in the market and historical based patterns. I referred to CCM's blog and videos before, but I do expect the market to be soft for a couple of days. So trade safe. I thank you all for being here. We are very close on the person add-on pricing to follow. I want to do a little bit more work on the package. You all have a great Sunday and talk soon. Goodbye.